Hey guys, it is Julie here with JT Wealth. In today's video, we are going to take a look at how to turn your government stimulus check into passive income for yourself. So let's get into it. All right, guys, happy 2021. This is our first video of the new year, so welcome and thank you so much for being here. Now, with government stimulus checks confirmed and expecting to be deposited soon, in today's video, we are going to take a look at 3 stocks with some pretty healthy dividend payments as a way to create passive income for yourself. So in today's video, we're going to give you a quick update on the stimulus check as far as how much you should expect and when you can expect it by. We're also going to discuss if you're actually in the position to be investing that check or what you should be doing with it. And then we'll get into 3 companies that are a great starting point for dividend income. And just before we get into all of that, this is just your friendly reminder that if you enjoyed today's video, make sure you hit that like button and leave your thoughts in the comments down below. Also, don't forget to check out some of the links we have in our description. Right now, Webull is giving away 4 free stocks for signing up and funding a new investment account, so make sure to check them out. Now, obviously, 2020 was a crazy year. A lot of people lost their jobs, and those who were fortunate not to were still in a very uncertain situation. So it really made a lot of us take a closer look at our financial circumstances. It was back in April that the government first did their stimulus of $1,200 per adult, and obviously a good bit of time has passed since then. Now we're finally getting our second round of stimulus checks. The second round of economic impact payments is generally $600 for singles and $1,200 for married couples. If you have young children, you could receive more money, as an extra $600 is available for each child who qualifies. But just like the first round of stimulus payments, an age limit is in place and parents aren't getting the extra $600 for dependents who are 17 and older. Now, for most Americans, this payment will come directly to their bank account as a direct deposit. And the direct deposits can hit bank accounts as early as Tuesday, January 4th or later. The IRS does warn that some Americans may see the direct deposit payments as pending or provisional payments in their account before the official date of the 4th. Eligibility for the payments starts to phase out at modified adjusted gross incomes of $75,000 for single filers and $150,000 for joint filers. The stimulus payment is cut by $5 for every $100 of income earned above that threshold. So a couple earning more than $174,000 won't get a second stimulus payment. And single people making more than $87,000 won't get the stimulus money now. But let's quickly talk about whether you should be investing this stimulus money or not. Now, obviously, I highly suggest investing this money versus just going out and spending it on new toys for yourself, but there are a few circumstances where the stimulus money may be put to better use. If over this last year you have been struggling to pay your monthly rent or other monthly bills, you might be better off putting this money in a savings account to help supplement those monthly payments. Likewise, if you have been relying on a credit card for a lot of those monthly expenses and are now carrying a balance at a high interest rate, put this money towards paying that off. So just take the time to have an honest look at your financial situation and see where this money can best be put to use. If you do decide that you're in the position that you are comfortable investing this money, we're going to take a look at 3 stocks that will pay some pretty nice dividends. As all 3 of these stocks have dividend yields over 7% and are all rated a buy by Raymond James analysts. The first company we're going to take a look at is New Residential Investment Corp. They trade under the ticker NRZ and are currently at $9.94 per share. Now, clearly, they did take a big hit back at the beginning of the coronavirus, but have been steadily recovering since then. This company is a real estate investment trust based in New York City, and the company's portfolio includes residential mortgages, mortgage loan servicing rights, and loan origination. NRZ focuses its operations on the residential housing sector. New Residential Investment has paid over $3.4 billion in dividends since their inception. Currently, they have $5.3 billion in net equity, a 40% total shareholder return since inception, and a $3.3 billion market cap. New Residential's business is basically broken down into origination, servicing, and investing. The investing portion is like the typical mortgage REIT, which holds loans or securities and earns money from a spread between the interest it earns and cost of financing. The servicing business involves managing the administrative tasks of a mortgage, including collecting payments, dealing with defaults, and ensuring taxes are paid. And the origination business is a direct-to-consumer model where borrowers interact with New Residential directly to obtain a mortgage. So these different businesses will perform well during different phases of the interest rate cycle. New Residential's diversified business model makes it a bit more resilient than the typical mortgage banker or mortgage REIT, and this makes their dividend safer as well. Now, the company did cut its dividend in April from 50 cents per share down to 5 cents, but it's increased the per share dividend to 10 cents in July, 15 cents in October, and is now planning a 20-cent per share dividend at the end of December. In addition to increasing their dividend, they've also announced a share buyback program worth $100 million. Analyst Stephen Laws, in his coverage of NRZ for Raymond James, writes, "We expect strong origination volumes and attractive gain on sale margins to drive strong near-term results, and we continue to expect a dividend increase in Q4. For Q4 of 2020, we are increasing our core earnings estimate by 2 cents per share to 35 cents per share. And for 2021, we are increasing our core earnings estimate by 8 cents a share to $1.31. In line with these comments, Laws rates the stock an outperform and has an $11.50 price target, implying a one-year upside of about 16%. And there are 7 other analysts who all agree. With 8 buy ratings, the stock comes in as a strong buy. With an $11.36 price target, that's about a 14.3% potential upside. Second on the list, we have TPG Refinance Trust. They trade under the ticker TRTX and are currently at $10.62 per share. Now, similar to New Residential, they also took a hit earlier in the year with the pandemic, but have been steadily recovering since then. They are also a REIT and are the real estate financing arm of the global asset firm TPG. Now, this REIT with an $820 million market cap has built a portfolio of commercial mortgage loans with an aggregate total of $5.5 billion. The company is a provider for original commercial loans starting at $50 million, mainly in U.S. primary markets. The largest share of the company's loans and properties are centered in the East. As far as their recovery from the pandemic, their revenues in Q3 hit $48 million, which was up 9% year over year. During the quarter, TPG received loan repayments totaling almost $200 million, which was a solid result. And when the quarter ended, the company had on hand $225 million in cash. Now, the company was able to easily fund its dividend of 20 cents per common share in Q3. For Q4, the company has recently declared not just the 20-cent regular payment, but also an 18-cent non-recurring special cash dividend. Taken together, the dividend will give a yield of 7.5%, almost 4 times higher than the average found among S&P listed companies. Stephen Laws from Raymond James has also provided coverage on this stock. He says that TRTX has underperformed since reporting their Q3 results, which we believe creates an attractive buying opportunity. We expect core earnings to continue benefiting from LIBOR floors in loans and expect new investments to resume in the first quarter of 2021. The company's portfolio has combined retail and hotel exposure of 14%, which is below the sector average of 19%. To this end, he does rate it a strong buy, and his $13 price target suggests about a 22% upside in 2021. There are just 2 other ratings on the TRTX stock, but both come in as a buy rating. The $11 price target is a bit lower than Stevens and represents just shy of a 4% potential upside. And last on the list today is Fdus Investment Corporation. They trade under the ticker FDUS, currently at $13.10 per share, and they boast a 9.48% dividend yield. Fdus Investment Corporation invests debt and equity capital primarily in lower middle market companies based in the United States. So basically offering debt solution and capital access to smaller firms that may not be able to secure lending from the largest markets. Their portfolio focuses on senior secured debt and mezzanine debt for companies valued between $10 and $150 million. Their approach is to invest in lower middle market companies with proven business models, leading market positions, high free cash flow, and strong management teams. They like to focus on opportunities in industries where they have prior investment experience. But their investment strategy also includes taking a proactive stance towards risk management, including conducting intensive due diligence prior to investing, utilizing their flexible mandate to structure their investments as to withstand both positive and negative events, and ongoing and active portfolio management. Fdus has investments in 68 companies with an aggregate value of $697 million. The largest portion of that portfolio, 59%, is in second lien debt, with the rest divided mainly between subordinated debt, first lien debt, and equity-related securities. The company has seen revenues gain through the second and third quarters of 2020 after negative results in Q1. The third quarter top line came in at about $21 million, which was up an impressive 129% sequentially. Since the third quarter, Fdus has declared its dividend for Q4 at 30 cents per common share, the same as the previous 2 quarters, plus an extra 4-cent special dividend authorized by the board of directors. So that brings their total payment to the quarter for 34 cents per common share and their yield at that 9.5%. This time from Raymond James, we are hearing from Robert Dodd, and he likes what he sees in Fdus. He says, "We continue to see the risk reward as attractive at current levels, with shares trading below book value, solid forecasted base dividend coverage, and we project that Fdus will solidly over-earn its quarterly base dividend of 30 cents per share through our projection period." He rates the stock as a buy and has a target price of $14, which would be about an upside of 10.5% over the next year. Now, analysts are more split on this stock, as it comes in at a moderate buy with 2 buy ratings and 2 holds. The average price target is $13.33 for just a 2% potential upside. So there we have 3 solid dividend-paying stocks, all with yields well over 7% and even some growth in their future. Of course, these videos are never a suggestion to buy or sell any specific stock. They're just meant for information and entertainment purposes, and for you to then go do your own research and due diligence on before making any investment decisions. Let me know your thoughts on these 3 stocks, or what other dividend-paying stocks you are loving right now. I always love hearing from you guys, so don't forget to put a comment down below. Now, with it being New Year's, I am doing a 3-week healthy kick here, so it will just be water for now, but thank you guys so much for watching. Have a wonderful day and a happy new year. Cheers.